Hi everyone, welcome back to Mike's Minutes. My name is Mike Dunn, a wealth advisor with IPC Securities. I hope everyone's enjoying the warm weather, and in lieu of the summerish vibes, I thought I'd wear a Hawaiian shirt, so please no comments on that. Golf courses are open though, so for those who know me, that's my thing, so I'm very excited. Been out a couple times, and I can't honestly think of many better things to be doing than just playing golf, challenging myself against the course. So whatever your thing is, I hope you're out there enjoying this weather. The hair's still long. Well, it's getting longer, but to be honest, I don't mind it. I don't know if I'll keep it, we'll see, but if I had a haircut in one of my videos, I'm sure I'd have a lot of questions, where'd you go, or you're going against the rules. So we'll see what happens when those open, and I think hopefully we'll be able to at least have the choice fairly soon. So again, thanks for joining me today, and today's video is going to be about 5 common mistakes that investors make. Before I go into that, I just want to remind everybody that today's information is strictly for educational purposes and not advice, and they reflect my opinions only. So you know the drill, I have to keep compliance happy, and there's my spiel on that. So let's get right into it. So the first common mistake that investors make is they procrastinate, or they just don't do anything. So there's always an excuse not to do something. And I relate finance a lot to exercise. There's always an excuse not to go to the gym. There's always an excuse not to go for that run or do that home workout or whatever your thing is. But half of the battle in getting started with anything is just starting in general. You don't have to spend hours and weeks and months on your finances or investing, but just getting started will create a pattern and a process that you can follow. And, for those listening, if you don't even know how to get started, that's what advisors like myself are here for. You could Google stuff like everybody does, but just to have a quick conversation with somebody, just, where would I recommend that you get started? Hey, I do that all the time. So please reach out if that's something you're struggling with. Mistake number 2 is investors tend to speculate and not invest. Prime example is the GameStop, the AMC, even BlackBerry at some point. These are speculative investments based on the trading and how they trade. It's not a long-term investment. There's not a whole lot of research being done on why you bought it outside of that everybody else is. So I'm not saying you can't speculate, because speculating can be fun. It can be exciting. But to put your retirement future on speculative investments, probably not the brightest thing to do. Like everybody's friends, babysitters, dog walkers, uncle, they all have stock tips. Everybody has a stock tip. But let's try to avoid speculating with a majority of our portfolio. The markets, we can't control what the markets do, but we can control how we participate, how much risk, how much time we have. So let's focus on what we can control and stop speculating so much on one of the most important aspects of your life. The third common mistake is that there's no plan. And there's no target rate of return, or ROR, if you're looking at acronyms. So I see over and over again people just trying to make money. Like, what's your goal? Oh, I just want to make money. That's a very difficult goal. So is like $1 okay? Or is $1 million okay? Or like, what is the goal? We all want to make money. That's why we work. But if someone's objective is just to make as much money as possible, when they're investing, they're never going to be happy. If you have goals and plans, it will help you continue down the right path. You'll start making better decisions when you actually have direction where you're going. So for example, let's say somebody wanted to have $500,000 when they retire. How do you get there? It's a combination of saving and investing, probably some tax planning in there as well. So how are you going to get the $500,000? Well, you have to figure out how much you can save. If you can only save a few $100s a month, and then you want to bank on performance or markets to take you the rest of the way, that could create some issues, because when you start concentrating on one area that's going to make or break your goal, it's higher risk. If you want to save more, you may not need a higher rate of return, therefore you're taking less risk, and therefore the ups and downs will be less extreme. So having a plan or a target makes an end goal a lot easier to achieve. So the fourth common mistake is market timing. I get this question all the time. When should I invest? When, the market's down today, let's put it in, or the market's up, I don't want to invest. It's a very tricky thing to do. It's actually one of the most impossible things to do as an advisor, an investor, an institutional investor. It's impossible. But I always say, if you have a crystal ball, please tell me. We'll keep it a secret, but please tell me, because I think we'll probably be the two most popular, or three, or however many claim they have a crystal ball. We'll be the most popular people in the world. We could run a pretty big business if we knew exactly what the market was going to do and when it was going to do it. So, market timing, please try to avoid that. And, there's statistics and surveys and reports and a lot of information proving that market timing has nothing to do with long-term success in investing. It's actually asset allocation that is the most important. So that's looking at your risk versus reward situation and matching that to what your actual risk is, your time horizon, and what your future goals are. That is how you become successful in the market. It's not market timing. So the last common mistake that a lot of investors make is a lack of patience. I think we all have a lack of patience for many different things. I think this pandemic has shown us that we have less patience in certain areas that we used to. But when it comes to investing, you need to be realistic with your goals, and expecting your portfolio to do something other than what it's designed for could be a huge disaster. So for example, if you have a client that's a conservative investor, so you might have 50% equity or stocks, 50% fixed income or bonds, that's a very middle of the road, conservative-ish to balanced portfolio. But if you expect 15, 20, 25% rates of return, and maybe over a 10-year period, you're expecting 8, 9, 10% average annualized return, it's just not going to happen, because that kind of portfolio is not designed for that. So you really have to be patient in terms of making money long term. If you have a higher risk tolerance, there's a higher probability that you're going to make more money over time. But as we saw just over a year ago, the market during a pandemic, it spooked a lot of people. And if you were patient and held on and stuck to your plan and knew exactly what to expect from the kind of portfolio that you had, you would be more than fine today. So patience is a virtue. I think my parents had like one of those, those little, sayings on a piece of wood stuck on a wall. I think they had one that said patience is a virtue, and that has always stuck in my head, especially when I became an advisor and more active in investing. Patience has been the best thing that's ever happened to me, because good things don't come easy, and building wealth and building an investment portfolio that's worth sizable amounts of money doesn't happen overnight. So you really need to be patient and stick to your plan. So, these are just, as I mentioned, 5 common mistakes. There's a lot more, but these are very common that I see and I hear a lot throughout my career, and I see with clients. But part of an advisor's job is to help clients avoid making these mistakes. What a lot of people don't see is that advisors get in the way of people accessing their money. So you have to have a conversation with a professional that takes their emotion out of what they're doing. This is my job. Every dollar that I invest for clients matters to me. I think about it all the time, but I also have the training and the expertise in this space that I know where you can make big mistakes. And these 5 are huge. And what we do is we get in the way. Clients at least have to have a conversation with us before they make a decision. I mean, we can't force people to do something, but we can at least educate them and have a conversation and calm down and take a step back and assess, the big picture. So that's a really big bonus that advisors give to their clients when they're working together. So keep that in mind. I said in my last video, don't worry about the commercials, all that stuff. I mean, this is stuff that people don't talk about, but these are probably the most important things when it comes to investing. I mean, those 5 are crucial to be successful long-term. So, as always, I hope you learned something. I appreciate feedback. I appreciate questions. So if there are any, please reach out. I have a lot of knowledge, and if there's things that I don't know, I have a lot of resources to check with. So I encourage you to reach out if you have questions. And if you haven't subscribed to my channel, please do so because I'm going to have a lot of great content coming out over the summer months. I got a dog, so I'm going to show you my dog. So stay tuned for that. So thanks again for joining me today. I really appreciate you taking the time out of your day. And as always, stay safe, stay healthy, and stay invested. Take care, everyone, and have a great day.